Really?
Yeah.
Well, good afternoon. We're here for the last session of the day. My name is Steve Pearlstein. Some of you may know that I used to write a column for the Washington Post. I still write for the Washington Post about economics. These days I'm actually a professor at George Mason University. And we're here to have a conversation with Paul Krugman, who is, needs no introduction. We were joking beforehand. Paul is a Nobel Prize-winning economist and a much sought-after academic who plays a journalist on television. And I'm a journalist who plays an economist and a college professor on television. So this will be a somewhat interesting interaction. So we're going to talk about the world economy, which is sort of an invitation to talk about anything that we and you want. But let's start with China. Paul, you wrote your twice weekly column this morning about China. You seem to criticize the Chinese for continuing to manipulate all sorts of markets, as they have to a degree for a long time. Yet, one of the rationales they have given most recently for allowing their currency to decline in value, at least as relates to the dollar and therefore everything else, is that they want to let it float a little more than they have let it float in the past. So if they were wrong in trying to manipulate markets, why are they wrong for trying to move toward a more free-floating currency?
Oh, no, they're not, actually. So, actually, I wanted to say something. I think it's an interesting point. Just step back for a moment and say, okay, China is obviously having big problems, and God knows it's not the first time an emerging market nation has had big problems. But what's really amazing, and we've all gotten in the last couple of years, either inured to it or haven't taken it on board, depending on who you are, is how unlike the past the problems are. I mean, I spent, as you did, most of my career in an environment where if you said developing country problems, you knew what that meant. It meant runaway inflation. It meant that they're irresponsible, they had deficit, whatever. But typically, inflation was the way it manifested. And instead, what you've got in China is actually looking like Japan or for that matter, Europe, and to a certain extent, the United States. Their problem is there's not enough spending, the economy is sliding, they're facing the risk of deflation. What? It's a very strange world, and I think it's quite remarkable. Now, the interesting thing about the most immediate issue about the exchange rate is actually China, a lot of people have not kept up, which it's sort of understandable. Things change fast. And everybody remembers that 5 years ago, China was clearly deliberately manipulating the renminbi, the currency. By the way, if anyone ever gets confused, if you know Britain, sterling is the currency and the pound is the unit. And that's more or less how you want to think. Renminbi is the currency, yuan is the unit. Anyway, but they were manipulating it, keeping it down to give themselves an export advantage, which was something that the United States was upset about but not quite willing to take action on. But that was 5 years ago. And since then, you've had a combination of rising wages in China, rising prices in China, rise of new competitors. The low-wage places in the world is now not China, it's Bangladesh or Vietnam. And they've also been pegging to the dollar, which has gone up against everybody else. So at this point, the Chinese currency does really look overvalued. Given the troubles they're having in their economy, there's actually a very good case for their currency to be weaker than it now is. The trouble is they seem not to have made up their mind. They've got to do it one way or the other. They either have to let the thing decline or say, okay, the risks of that are too great, in which case we're going to hold for the peg. What they decided to do instead was to try to get a little bit pregnant. Or as my old teacher, Charlie Kindleberg, used to say, take the first bite of the cherry. Nobody only takes one. So they said, well, we'll let it devalue by 2%, but only by 2%, which of course had everybody saying, well, now that they've broken the line, now it's going to be much more, and so capital started to flood out of the country, leading them to a panicky attempt now to stabilize it because they're not ready for the 15 or 20% decline that would probably happen if they let things float. So it was a hard column to write and probably didn't work very well for a lot of readers because there's a pretty good case for them letting it float, but a really bad case for letting it do a little bit.
But is it such a bad idea to say, well, look, we're going to move toward it floating, but we want it to be gentle. We don't want it to be disruptive, and so we're only going to let it vary by 0.5% a day.
No, because that gives speculators a perfect target. If I were a Chinese, or even non-speculators, just ordinary people, but with some mobile funds, if I were a Chinese national and I saw them actually, as many did, if am I a Chinese national and I said, oh, looks like they've decided they don't want to keep the peg anymore, but they've only moved it a little way, so that means over the next few months, depending on how you want to look at it, there's either a surefire loss of 15, 20% if I leave my money in China, or a surefire capital gain of 15 or 20% if I move my money out. So you're just creating a perfect, what we used to call, I guess, the one-way option for speculators. Mm-hmm. It's, this you don't do. Again, so either do it or don't. Okay.
So in other words, you have to do it cold. You have to do it cold turkey.
Try not, do or do not. Yeah. Yeah.
So explain a little bit about the money moving out, because can ordinary Chinese move their money out? Can they exchange their renminbi for something else, or can they put their money to exchange it and put it in a Swiss bank account? Are they allowed to? Is there an open capital account?
No. So China has controls, which is part of the problem, because if you're going to float your currency, you want, in fact, enough people to be able to stabilize it by betting, by moving money. But no, there's a lot of controls, except they're porous. So you cannot just, as a Chinese national, say, okay, here's my bank account in Beijing. I want to cash it out and turn it into dollars. You have to show reason for it, but there are so many channels through which you can leak it out. You can disguise it as an ostensibly necessary transaction. You can, if you're an exporting or an importing firm, you can. If you're an importing firm, you can pay your bills early, so that you've effectively converted some of your yuan into dollars. Or if you're an exporting firm, you can say, don't pay us just yet, and that's all serving the same purpose. So the controls mean that if you're the United States, or actually if you're Greece, well, they don't have, sorry, but if you're a country, if you're Denmark, if Denmark were to, for some reason, start to slowly depreciate, they're pegged to the euro, if they were to slowly depreciate the krona, instantly, 20% of GDP would flow out the next day. China, it's going to be slower than that, but it's still fast enough. There are some estimates that say they've had $800 billion of capital flight over the past year. I'm not sure if I trust that number, but it's very big numbers. So the controls mean that things don't move in milliseconds the way they do in open markets, but they move.
And it's bad for them if their capital flows out?
Well, the trouble is they have to spend, then they end up spending a lot of reserves, propping it up, and it also raises interest rates, it tightens money at home. All of that is, the whole thing about exchange, on exchange rates, you want currencies, if they're going to move, you want it to happen, have it be in the past, not be something that people see coming and have time to, where the prospect of a further decline distorts incentives.
So a long time ago, you wrote a seminal work, and you showed, with using some very elegant models and mathematics, that it was possible for a country, a particularly developing country, to engage in strategic trade, to manipulate, and I'll probably get this slightly wrong, but manipulate its currencies a little bit, to limit exports and imports in some way, maybe to do some subsidies, but to do that in a way that allows them, in ways that most neoclassical economists said would always be bad, to actually to accelerate the development.
Actually, okay, that's way more than I ever claimed. But,
okay.
But look, if we're going where I think it is, though, the question is, what? In fact, it's a very different story. What's the important point about the last 7 years, ever since the financial crisis, is that we've been living in a world where basically everybody has insufficient demand. Everybody's depressed. Everybody has monetary policy is as normal monetary policy anyway, is as far as it can go. Interest rates are zero. There's just not enough spending in the world to employ all of the willing workers in the world, which means that we become a world in which mercantilism, discredited mercantilism actually becomes simple truth. That exporting is good, importing is bad. A country that can devalue against other countries is gaining jobs at their expense. So we've been in that nightmare world so whatever you might think about normal times, although at this point, 7 years of abnormal times and counting, it was definitely the case that that for most of the last 7 years, China was in fact gaining an advantage at our expense by having an undervalued currency. Now they've managed to lose the undervaluation at this point, but yeah, it's that the best solution would be for everybody to reflate, but actually Jim Tobin, late Jim Tobin, I remember him saying during an earlier recession that right now it looks to me like everyone needs to devalue their currency, which is kind of a problem, right?
Right. I guess what I was driving at is, would you give the Chinese some pretty good credit for the way they've managed their economy over the last 25 years?
Not much. I mean, they did do some things right. They actually, whether they knew why they were doing them is not clear, but their capital controls actually served them, I think, very well. They were pretty much, during that period in the 1990s, when all the money was rushing to developing countries and then rushed out again, creating what we thought was a big crisis at the time, although it looks trivial by later standards, the Chinese were well insulated from the whole thing. So that was a good thing. Their opening up of the economy has been spectacularly successful. I have to say the last few months have made you wonder, did they ever know what they were doing, or was it just that they happened to kind of, there's these guys in Beijing sitting on top of a country that's got tremendous energy and entrepreneurial drive, and they're busy issuing orders and making policies which are pretty much irrelevant, but they think that they're doing it. And I'm beginning to suspect that, because right now it looks like they have no idea what they're doing.
You don't want to give them credit for having sort of, rather than doing a big bang, sort of a managed transition to...
No, that definitely. Okay. I mean, I'm not sure that they did it for the right reasons, but that's right. No, I think in this throw thing wide open all at once has been a disaster for a number of countries, which have had the massive, the hot money comes flooding in, then changes its mind and it wreaks havoc. So the Chinese avoided that, although they're now seen to be working on their own sort of domestically generated version of the thing.
How fragile do you think their economy is? We don't really know all that much about it, but how fragile do you think it is, and how important, if it were to have either a financial crisis or at least a very dramatic slowdown, how much should the rest of us care about that?
Okay. Yeah, so first of all, we really don't know. I mean, it's amazing, actually. I was at the Asian Financial Forum a few months ago, and while I was there, China announced the latest growth number, which was, I think, 7.3%. And a lot of the people at the forum were asking, why did they decide to announce 7.3%? Nobody asked why was it. Nobody asked why the growth rate was, in fact, what it was, because everybody assumed that the number was a political decision. So the Chinese numbers are completely what the government has decided to say, not what the data are actually telling it.
Do you think they know?
No, probably not.
Okay.
Because remember, it's turtles all the way down. It's at the level of the township. The township officials are telling the people above them what they think they want to hear, who in turn, so all the way up. They probably have no better idea than we do. What I think is China has it's a very difficult transition, because they have an economy. In a way, it's a Ponzi scheme. That's really not quite fair. But they've had an economy which has had huge amounts of investment and not very much consumption. 30% of GDP is consumption.
Compared to 70 for us. Right?
Yeah. So they've been investing like crazy, but not really investing to produce capacity to serve consumers, but investing to produce capacity to serve future investors. And so now that can go on for a long time, as long as the economy grows really, really fast, as long as it's achieving growth rates of, well, whatever the real number was, but they were certainly very high. But they can't do that forever because a lot of that depends on putting a lot of underemployed peasants to work in the urban areas, and they basically are running out of peasants.
Are they? You think that?
Yeah. Well, you can see it. I mean, obviously, there's still lots of peasants out there, but on average, they're old, they're not movable, they're
Right.
people who, for whatever reason, are not.
But the young ones are all moved.
Right, and you can see that because wages have risen a lot. I mean, I was just looking at that. When we first started getting reasonable estimates of Chinese wages, which was about 2004, they were put at 3% of U.S. wages. And the most recent numbers which we have, which are about 3 years old, are putting it at 9 or 10% of U.S. wages. So that's a very rapid increase, sign of labor shortages. But then what happens? Once everybody understands you can't grow so fast, there's no way you can keep on investing at previous rates. So investment has to drop off. You need to have a kind of revolving door where consumption rises to take its place. But there are reasons why consumption is low. Tremendous insecurity, lack of social insurance, or actually insurance in general. State-owned enterprises are very reluctant to let the income they generate go to anybody outside the people controlling the firm. So how do you make the transition to having a reasonable level of consumption fast enough to take the place of the dropping investment? It's a little bit like what Japan actually faced in the 80s at a much higher level of development. But Japan had a high investment economy that inevitably was going to slow down, but had a very hard time of it because they had a hard time making the transition to a more normal balance. And some people have been saying that China is basically Japan without the social cohesion. It's it's something that's really kind of worrisome for China. China, for the rest of us, well, China it's a big economy. It's not as big as the United States. It's not as big at market values, which is the way you ought to measure it. It's still only a little bit bigger than Japan, but it is bigger. And if a big economy that's been growing very fast comes to a dead halt or even goes into reverse, it's bad for anybody exporting raw materials, which is a lot of other countries, a lot of developing countries. Probably not as big a deal as, probably not 2008 all over again, but sort of definitely a sense of given all the other troubles in the world, did we need this?
Europe. You've written a lot about Europe, bad fiscal policy or misguided fiscal policy, and until recently, misguided monetary policy. How much is the funk that Europe is in and to some degree has been in for a while, how much is that bad macro policy and how much of it is that they seem stubbornly reluctant and slow in making the reforms to labor markets, product markets, capital markets to get out of the funk?
Okay. And that's a subject which, of course, gets totally bound up with domestic politics here. There's a lot of people who want to believe that Europe is basically being punished for having strong welfare states. And on the other hand, of course, those of us who are kind of would like our welfare state to be stronger are going to be suspicious of those arguments. I think what you really need to understand is that that Europe is a bunch of different countries which are quite different in their story, quite different in their institutions. That France is not Greece, actually, and France is not Italy. And so you really need to distinguish. And I like to talk about France, partly because it's the country that a large part of the U.S. political spectrum loves to hate. And actually, that the financial industry really is, there's a constant bad-mouthing of France, which I like because once you start to look at the facts, it turns out that it's kind of, it's way over the top. So let me do the France-U.S. comparison and then talk about the others. Actually, I do this, I have a course that I guess I'm going to port over now to my new institution as well. A course I developed for the Woodrow Wilson School called Economics of the Welfare State, which is mostly international comparisons. And I do a lot of France-U.S. comparisons, which is a good thing to do because it turns out that the French are, in some ways, they're basically at the same level we are. Productivity, output per person hour is just about the same, within the limits of measurement. It's the same in the two countries. Technological sophistication is about the same. Neither country looks backward in any particular, in any wide set of dimensions. But very different choices. So France has a far more generous welfare state. At this point, actually, France is probably the biggest government in Europe, even bigger than Sweden. They have many more benefits. They have much more, they work a lot less. France has the same productivity that we have, but it has only about 3/4 of our GDP per capita. And the reason for that is largely early retirement and much more vacation time. So per hour, but they work less hours, partly because a lot of people do retire in their late 50s, but mainly because the work year is much shorter because they actually take vacations. Is France a deeply troubled economy structurally? It's not at all clear that it is. They do not have a fiscal crisis. They're able to borrow at the lowest rates in their history. Employment. If you look at prime age, look at people 25 to 54, France and the United States are at this point significantly different. Their employment rate among prime age adults is significantly higher than ours is. If you are a person in your prime working years, you're more likely to have a job in France than in the United States. The young French are much less likely to be working. But a lot of that, some of that is probably because it's kind of hard to find jobs. Mainly, or at least half of it seems to be because financial aid for students is so much more generous that many fewer French young people need to work while in college. And then there's a lot of early retirement, which is a problem because they can't really afford that, and that they screwed up on that policy. But performance doesn't look at all bad. If you hadn't read all those stories about how France is in crisis, you wouldn't see it. And they've been doing badly the last few years. Oh, by the way, and growth, output per working age adult has tracked the United States quite closely over the past 25 years, until about 3 years ago, when France began implementing all these austerity policies, because that's what Europeans are doing these days. And when people say, what ails France? And I often say it's hypochondria. The French have been convinced that they're sick and they need to slash their budgets. And the markets aren't saying that, but the politicians are. So if your image of Europe is France, hey, it's not so bad. If your image of Europe is Italy, something has gone terribly wrong in Italy. Italian growth stalled completely. If you go back, at this point, relative to the late 1990s, Italy has done as badly as Greece. They've done it. Their catastrophe has been slower, but it is really bad. And we don't really understand why, but productivity in Italy has just collapsed. They just seem to have lost all drive in their economy. And then, of course, you have the Greek, the Southern European story, which is yet another thing. So it's very, actually the worst, sorry, not the worst, but there's a tier of economic failure across the top of Europe. Finland is having a slow motion economic disaster. Nobody thinks about that because it's not conspicuous, and the Finns seem so sober and reasonable, but they've actually really screwed up very, very badly. Denmark is doing surprisingly badly. The Netherlands surprisingly badly. So it's all a very mixed story, which has the problem that people's preconceptions get in the way of seeing the differences clearly.
So I'm more of a business reporter than an economics reporter. So I can tell you another story. I can mention Peugeot and Citroën. I could say France used to dominate the wine industry, not so much anymore. It used to dominate the clothing industry, not so much anymore. These are export industries. Agriculture, inefficient, no scale. Retail, two-tiered, but one tier, inefficient, no scale. Healthcare, other than the United States, the most expensive spending per person.
Oh, not remotely. Sorry, that's
no,
not true.
after us.
No, Switzerland is number 2.
Okay.
And France is actually, I thought, not much higher than Britain or Canada.
No, it's the highest in.
Well, no, that can't. I'm sorry. That,
Okay,
we'll settle this outside. Anyway,
minimum wage to the median is the highest in the OECD. Not surprisingly, high youth unemployment, although it also reflects an insider-outsider labor market. Worst labor relations. Now, all of these things are things that business types, when they go to do competitive indices, say, here's why they have a brain drain. Here's why, when there's a big French company and they have some money to invest, where do they invest it? They invest it outside the country. So why is it that these sort of so-called competitiveness things you tend to dismiss, and whereas business people put a lot of stock in them? Why do you dismiss the competitiveness?
I think because, first of all, if some of these are not results, they're things that are presumed to have terrible effects. When you say the high minimum wage, is that really? I mean, I don't believe that minimum wages can go up without limit, but do we really know that that's a major problem? Again, bear in mind, employment to population for prime age workers is better than ours.
Well, you know an argument that you've made the argument that one of the reasons that GDP per person per hour in France is high, you know this, is if you don't allow your low productivity workers into the formal economy because because the minimum wage makes it illogical to employ them, then those who are employed obviously have a higher average output. But if you basically don't have the people who bag groceries in our country in that economy, then on average they're as productive as we are.
But you can slice that further, look at manufacturing, and it still looks no real difference. But let me say, the other thing is that there are lots of anecdotes. So suppose I talk about internet access.
Yes.
France has faster speeds significantly than ours at much lower prices. So if we're talking about the information economy, they've actually handled that way better. Does that count less than, the auto industry? Okay, but is not that the U.S. automakers have done that great over the last few decades either.
No, but our industry. Let me just give you an example. Our industry now, we make more autos in the United States than ever before. They're not made by American companies, all of them. But the fact is, those companies don't go into France, so they can't make them in France. And there's a whole lot of reasons why they don't. Some of which is, for example, France is a relatively closed economy within Europe. That is to say, their exports and their imports are less than other countries. They like to do it themselves.
Not more so than anyway. But and then if competitiveness is a huge issue, I should be seeing a major shift towards trade deficits in France, which you don't. It's they have a small trade deficit. Whenever anybody gives me a bunch of anecdotes, you want to say, okay, that's great, but I don't know how important they are unless I can get some proof of the pudding is in the.
You once used a put down with me many years ago. You wouldn't remember it, but you once said to me, the plural of anecdote is data.
Yeah, that's right. But the question is how many. And particularly, I didn't mean to turn this whole thing into a discussion of France, but the urge, the francophobia of a lot of the business press is so great that it's just a continual. You worry that it distorts the choice of anecdotes. You just hear so much, and again, I keep on seeing articles that talk about fiscal crisis in Southern Europe, Italy, and France, and France is able to borrow at 20 basis points above German. That at least is completely in the imagination of reporters. So maybe it'll turn out that France is in worse shape than it appears, but certainly nothing like the image that if people have this story where they think of Europe as being it's all like Greece and it's because they have a French-style welfare state. And sorry, but those are completely different stories.
Although I would say there's a difference between welfare state, which is the degree to which the government provides people with stuff, and there's a second thing, which is the degree to which the government prevents the competitive operation of labor markets and product markets and even capital markets, which is not a sort of providing a safety net, but simply inhibiting competition and entrepreneurship and innovation. that's a sort of separate, I think, issue than the size of the government or the amount of the welfare payments or the pensions or that sort of thing.
Yeah, but it's but again, sure, there's always going to be questions like that, and when I'm in Europe, I can become an ugly American and start lecturing them. Although actually, if you're looking for annoying regulations that seem to get in the way of stuff, Germany would be the place which is really full of them. Basically, in Germany, unless it's specifically permitted, it's prohibited, and yet that doesn't stop them from being dangerously competitive.
Let's turn to another subject, which is secular stagnation. Briefly tell us, what is it? Is it real? And we're talking about advanced countries now, and particularly the United States, and what are its causes?
Okay, so economics is full of jargon, and sometimes the jargon is there because people are trying to be obscure or impress you, and sometimes it's there because historically somebody came up with a really inapt phrase and it stuck, and no one quite knows how to shift it. So secular stagnation is a phrase that goes back to the 40s, and doesn't at all mean what you might think it might mean. Has nothing to do with religion or lack thereof, and it doesn't really even mean stagnation. So secular stagnation is the argument that we have a persistent shortage of investment opportunities, so that there is not enough demand to maintain full employment. It's not the same thing as slow growth. You could be having slow growth, but not secular stagnation, and you could actually have secular stagnation with relatively high growth in the brief periods between recessions. But it's basically saying the economy is very much recession prone, deflation prone, because there's just not enough investment opportunities out there. And it was originally the original proponent of the idea, the American economist Alvin Hansen, writing in the 30s, said, well, this is our problem. We are, and he traced it largely, he thought it was because of the collapse of population growth. That because of slow population growth, there were just not enough investment opportunities, that so much of investment is, in fact, driven by a growing population, both housing and things like building factories to employ a growing workforce, that the economy has a bias towards being depressed because the population growth has gone away. It turned out to be wrong, but not necessarily because the economic logic was wrong, but because he didn't see the baby boom coming. And so that became a moot point. But now, what you can see, several people started reviving this old idea, and I did it, but badly written and incomprehensible. And then Larry Summers gave an absolutely brilliant short talk, and so he rightfully deserves the credit for the modern revival. If you look for the United States, if you look since the 1980s, it's getting harder and harder to engineer recoveries from recessions. It's not so much the 1991 recession wasn't that bad, but it was hard getting the economy moving again. The 2001 recession wasn't that bad, but it was really hard getting the economy moving again. 2008 was hell on wheels, but also a very sluggish recovery. Interest rates have been trending downwards, suggesting that businesses don't seem to find reasons to borrow, and if you start to ask what might be behind that, well, population growth has been slowing, working age population especially, and then we have the example of Japan, which has been fighting persistent deflation, an economy that wants to be depressed, and which has a rapidly now shrinking working age population. But we're all starting to look Japanese at this point. And so the secular stagnation story is saying, gee, maybe there's something going on that is more than just that we screwed up on housing markets and so on in the last decade. Maybe it's in fact that the engine of full employment is sputtering in a more fundamental way.
Could it possibly be a demographic phenomenon plus too much savings, a savings glut?
It could be. It's not clear there's a whole lot of saving, but but it could be a savings glut. It could also be a technological that a slowing of the pace of technological change. And that's one of those things where technology, on the one hand, we're constantly encountering things that you could never do before, and some of it seems very fast. On the other hand, you can step back. I mean, Peter Thiel, I'm not a fan of his in many dimensions, but he has one of the best lines ever about technology, which is, we were promised flying cars, and instead we got 140 characters. So there's at least an argument that says that technology is certainly not delivering enough real investment opportunities out there. So it's a serious thing, because if it's true, then economic policy needs to reorient itself towards the biggest problem becomes not actually one of expanding capacity, but one of making sure there is enough demand to make use of the capacity.
So I'm going to ask you some very quick personal questions, since I suspect a lot of reasons people here because you're an interesting fellow with interesting ideas and interesting minds. So how many emails do you get a day?
Okay. That's the ones that make it past the filters,
Yes.
probably a couple hundred. I have filters. I actually, I said something, I don't even remember what, but I said something about Michelle Bachmann once. And over the next 72 hours, I got 5,000 emails. And so...
you put Michelle Bachmann in the
Well, the filters include communist, socialist, liar, and then misspellings. Communist with one M, liar, L-I-E-R. And so if you include all of those, God knows how many I get.
And how many do you answer?
Oh, not more than a dozen or so.
How many blogs do you read a day, and how many hours a day do you read basically other blogs?
I think it's about an hour and a half a day, and there's a core group of I don't know, 7 or 8 blogs that I read every day, and then others occasionally, or following links or people who suggest it. I mean, these are golden, for what it's worth. This is a golden age of real-time economic discourse. There's a kind of interactive set of very bright economic thinkers, some of whom are formally trained economists, some of whom aren't, but that doesn't matter if they have interesting things to say. And we're seeing really interesting debates playing out fast. I mean, I was raised on classic debates from the 1930s, Keynes-Olin, whatever, and we're having debates as interesting and as good as those, but they play out in internet time. So you'll have just a back and forth over the course of 2 weeks between half a dozen really smart people. So it's really worth paying attention.
And what's the best blog of someone with whom you generally don't agree that you read?
That's an interesting question. I think probably people probably wouldn't know. David Beckworth, market monetarists, who are people who think that the Fed could really solve all of this if it really tried, are the ones that I think are interesting. I treat with respect, even though I don't agree.
What's the hardest economic concept to get undergraduates to understand? What's the one thing that they somehow can't get?
Oh wow! Actually, interesting. It used to be that we would always say comparative advantage in trade, but actually, I think it's the possibility of inadequate demand, the possibility that there just isn't enough spending. That's what people, undergraduates to some extent, but even more, I think, just bright people, but who haven't gotten into it. It's so easy to make what sounds like a rigorous verbal argument that says it can't happen, and then it's really, really hard, but in fact it can. So I think that's probably the hardest single thing actually to get across.
If you had to vote for one of the Republican candidates in the primary.
Oh, in the primary, I vote. Well, wait, first of all, as a Times columnist,
you can't be strategic about it.
Oh, sorry.
You can't be strategic about it.
It was going to be Trump.
No,
but anyway, no.
You can't be strategic.
No, well, John Kasich is not completely crazy, which puts him head and shoulders above everyone else in that field.
I'm with you on that one. The column you most regret, the column you most wish you never had written.
Oh, wow. Actually, it actually goes back to pre-Times days, but I was very caustic about people claiming a productivity surge in the mid-90s. partly because I thought they were making logically incoherent arguments, which was true, but they were in fact what the buzz from the private sector that wasn't actually in the statistics, which I was dismissive of, turns out to have been true. That there really was a productivity revolution, a surge, and I feel I think I learned a lesson, which is if you hear a buzz from people, even if it's not in any of the official numbers, it doesn't have to be true, but you want to take very seriously the possibility that it is. So that's what I really regretted.
If Hillary Clinton called you up after being elected president and said, I need the best economic advisor other than yourself, who would you suggest she hires as her chief economic advisor?
That's a hard one to. It's a bunch of good people, and it's actually it's a pretty rich field of reasonable people out there. And I'm blanking on who I would actually prefer. I'm sorry, I should be able to do that. But no, it's interesting actually. We were told politically about the deep bench of the Republican candidates, which is turning out to be kind of not exactly but in terms of Democratic leading economists, there really is a very deep bench. There's just really a lot of very good people.
We're going to have your questions, and even your comments are okay. But whatever they are, they need to be very short. And please tell us who you are and wait for a microphone. And who's going to start? Yes, sir. Right in the middle row, the hardest person to get a microphone to.
Mark Lapine, I would like to ask Mr. Krugman, could you please give me your insight into India in this world economic outlook and their importance?
Wow. Okay, so India, Steve and I were
we were going to do India, and we decided not to.
We're both old enough to remember Professor Irwin Corey, the world's greatest authority, so I can bullshit on anything. I don't know much about India at all. Things I do know. It's going to be the world's most populous country. We're on our way because of China's one-child policy. That India is going to overtake China, and hopefully in my lifetime. It sort of depends on my health, I guess. And as we're finding out, human beings are human beings. That if you think that some country is incapable of achieving modern economic progress, eventually you're going to be proved wrong. And India has already shown much more capacity than people thought. They have the problems of still a very inadequate in public investment of various kinds, including education, infrastructure. India has a peculiar pattern of development which has been more oriented towards services than any previous emerging market. Part of which may be because they actually have some skills in that dimension, and the relatively widespread use of English may have helped in some of it, but also because they don't have the damn transport infrastructure that would let them ship goods out of the country. So I don't think India, it's not yet showing the possibility of achieving the kinds of very high growth rates that we saw in East Asia, but they've been doing pretty impressively. And I think India, they're still a much smaller player, but it looks likely. I mean, they're having some problems of macroeconomic management, but those are probably transitory. And I think I think they will actually become a major player as long as they don't choke on the air pollution. Because Delhi is far worse than Beijing, and as I can attest to from personal experience. So that is actually going to be a big problem.
Follow up, are there bigger challenges? Are they macroeconomic or are they institutional microeconomic?
Oh, I think it's microeconomic. The problem with India is, I'm not even sure if it's, it is institutional. There are reasons why they have done so poorly at infrastructure, at education, and in general. It's a much, the more or less modern part of their economy is still much smaller than it is in China.
Way in the back.
Joshua Landis. For the bottom 20% of countries, we've talked about all the winner countries that are doing pretty well. What about the countries that are not doing well? Is there hope for them? Is the Middle East and Africa, are we going to see a lot more immigrants coming to Europe? Are we going to see a crash with bad education, youth bulge, overpopulation, bad government, or are they going to make it through?
Okay, I'm way more hopeful about Africa than I ever was before. I mean, we used to make sort of black humor jokes. You would find sentences in reports saying things like, per capita income in the developing countries of sub-Saharan Africa has been declining at 1% a year, and if per capita income is declining, they are not developing. But at this point, they actually are. You actually do have significant growth from an incredibly low base, but I think you actually are starting to see what are real economic progress in significant parts of Africa. I think and part of that was that there was a commodity boom, which is now turned into a bust, but I don't think that's the whole story. There are a few things that seem to be going right. Some of them are that there are a lot fewer wars. This is one civil war can ruin your whole day, and they are. But also, it seems as if technology, some of technology at least, are actually now working a bit in favor. So think about communications. The cell phone is a technology that is a godsend to countries that have had a very difficult time in putting in a hard, wired network. All of a sudden, they have access to the modern world and to modern communications. So it's still, in absolute terms, still terribly bad, but it is. Africa, I think right now my model of the world is that there is this sort of there's some bug that makes it possible for you to join the modern world, and for a long, long time that thing didn't spread beyond Europe, European offshoots, and Japan, and then it started to spread to the rest of East Asia. But now it really does look as if it's getting into quite a few other countries as well, as if Africa is not going to be excluded forever. 10 years ago, I might have said I still see no sign of a transformation there, but now you can see at least the first glimmers of it.
That gentleman over there, yes.
Michael Dennis, you were talking about inadequate demand, slow growth. Meanwhile, most of the major economies are piling up huge amounts of debt, at least in the public sector, at historically low interest rates. How do they get out from under? Or if they do, restructuring or inflation?
Okay, historically, high debt levels. First of all, actually, very few countries, even now, are at the kinds of debt levels that have anywhere near peaks as a share of GDP. Britain has several times in its modern history had debt of 250% of GDP. The Industrial Revolution took place in a Britain that had debt that was about 200% of GDP. So it's because of the Napoleonic Wars. You want to be, not. Historical perspective makes you quite a lot calmer about these debt levels. But if you ask how does that come down, it very rarely, certainly it very rarely comes from actually paying off the debt. Instead, it comes from eroding the debt, eroding the debt-GDP ratio, partly through inflation, partly just through economic growth, and financial repression in the form of either just deliberate policies to keep interest costs low, or just plain easy money policies that keep them fairly low and produce a bit of inflation. That is the way that it has historically been dealt with. And it's funny, that's another one of those phrases that's unfortunate. Because you say financial repression, that sounds terrible. And you talk about, Europe, the Western world, actually the United States as well, got out of the debts from World War II with 30 years of financial repression, which were also the most prosperous 30 years in the history of the world. So it's not such a bad thing. But no, I don't think there's any reason to believe that if you can get growth going again, the debts that we now have are a big problem. The trouble is of course, the intersection of high levels of public debt with secular stagnation might be nasty. So this is why we worry about these things.
Two more. Yes, sir.
Hi, Chris Kasich. This is the unemployment technology question.
Right.
Mechanization displaced lots of jobs, blue-collar workers. turn of the 20th century. And now you see that displacement happening in white-collar workers with new technology. Some people believe it's a little different now as computers are able to think, and some companies are devoted now to the idea of creating computers that you would rather consult than a human. Is that something you see speeding up, or do you think that there's always going to be new jobs to be created as a result of new technology?
Yeah, okay. I don't know about always. There's probably, for quite a few decades yet, there will still be a substantial range of jobs that you need people for. It's actually, computers still have a very, very hard time. Machines have a very hard time dealing with the complexity of the real world. So and a lot of what we think of as menial labor actually involves cognitive processes far too complex for us to do with artificial intelligence. Now, probably will not forever be true, and so somewhere along the line we may have a real problem where humans are not needed for anything, although probably Skynet kills us all before then. Probably not enough people watch Terminator movies. If you actually ask now, think about where are we adding jobs, or where have we been adding jobs? And so office work, traditional routine office work has been shrinking, but healthcare, for example, has been a big source of job growth, and it turns out many of those are actually middle-class jobs. So the notion that all the good jobs necessarily go away is not true. On the other hand, if you actually look at the history, it's true that mass technological unemployment has never happened. But long periods of time when large numbers of workers are hurt by technological progress have happened. The Industrial Revolution in Britain eventually worked to everybody's benefit, but as best we can tell, we don't have great data, but as best we can tell, there was something like a 40-year period of wage stagnation when technology was progressing and workers were not seeing real wages go up, and in many ways, because of urbanization, where actually the quality of life was going down. So if you say, don't worry, 40 years from now, we'll all start to see benefits from this with a little bit of mass suffering in the meantime, that's not terribly encouraging.
Last question.
Thank you. What would you imagine to be the implications for the U.S. and the world economy if the Iran nuclear agreement is enacted?
Oh, wow. If it is enacted, then things go on pretty much as they have been. There'll be probably more oil coming forth from Iran, but we're already kind of, at least for the time being, in a glut of oil. If it's not enacted, then I worry. Not my expertise, but I'm a citizen who tries to keep up with these things, and I'm terrified of what would happen if we reject it. I have to say that there's this weird, really bad argument that for some reason John Kerry decided to make, which is that failure to enact the deal could endanger the international role of the dollar, which is not actually something I'm worried about. But it's, I hate it when people always think the 70s are coming back economically. That's been a really bad thing. But recreate war in the Middle East still does not seem like a good idea.
Okay. Thank you very much.
Okay.
There are some books on sale outside, including this one by your guest.
All right.
Thanks.